Hello everyone, welcome to Options Discovery on John Lothian News' The Spread. My name is Asma Awass and I'll be your host throughout the series. Just like you, I'm no expert, but with the help of some, we can learn more about options together. In this episode, we will be talking about the collar strategy. Later in the episode, I'll get a chance to sit down with Doug Ashburn, the executive editor at Britannica Money. Doug discusses the fundamentals of the collar strategy and his own experience with it. First, let's go over some of the basics of an option collar position in equities. There are two components of a collar, a protected put and a covered call. Before we get into why traders use the collar strategy, it's important to understand what a protected put and a covered call is. The combination of the long stock and long put creates a protected put position. In this strategy, the premium is the price that a trader must be willing to pay. The benefit of the protective put is that the trader's downside loss is limited while the upside gain is not. The combination of a long stock and short call creates a covered call position. The short call has a higher strike price than the underlying stock. In this scenario, the trader makes income by collecting the premium with the hope that the call option will not be exercised at expiration. So, if we pair the protective put and the covered call together, we get the collar strategy. But why would a trader want to use a collar? One reason is that the downside potential of a long stock is limited by the protective put. Another reason is that the premium paid for the put can be offset by the premium collected from the call. However, there is limited upside potential from the call strategy. As shown in the graph, the maximum profit a trader can get from the strategy does not exceed the call's strike price. So, now that we know the basics of a collar strategy, there's a few things that we should keep in mind. Both the protective put and covered call are out of the money when used in this strategy. This is because they are used as a backup if the long stock plummets in value. Another point to keep in mind is that the protective put and covered call generally have the same expiration and same number of contracts. Another aspect of the collar strategy is the break-even point. The break-even point is calculated by adding or subtracting the net total of premiums from the original stock price. For example, let's say that you bought 100 shares of stock for $70 a share. At the same time, you purchased a put option for a $65 strike and you paid a premium of $4. You also wrote a call option for a $75 strike and collected a premium of $5.50. The net credit of the premiums is $1.50. To get the break-even point, you would subtract the $1.50 from the original stock price and get $68.50. An options trader must also keep in mind the maximum profit and maximum loss. In our example, the maximum profit is calculated using this equation: the call strike price minus the stock price plus the net credit of the premiums. The maximum profit would be $6.50 a share. The maximum loss is calculated using this equation: the put strike price minus the stock price plus the net credit of the premiums. Again, if we refer to our example, the maximum loss would equal to $3.50 a share. In this example, the premium we paid was less than the premium we received, which resulted in a net credit of premiums. In many cases, the premium we pay is greater than the premium we receive, which would result in a net debit of premiums. This change is important to keep in mind as it will affect the max profit and max loss calculations. To talk more about the collar strategy, I sat down with Doug Ashburn, the executive editor at Britannica Money. Doug has had a lengthy career in the derivatives industry and gives more insight on the fundamentals of the collar strategy. Without giving away too much, please enjoy an Options Discovery interview with Doug Ashburn. Hello everyone, welcome to another episode of Options Discovery. Today I'm going to be sitting down with Doug Ashburn, who is currently the executive editor at Britannica Money. Doug, can you give us a little bit of an overview of your background and how you got to where you are today?
Sure. I spent about 24 years or so as a market maker and options, primarily options on foreign exchange at the CME. And I moved into the financial media world about 12 years ago, working actually, my first job as a media person was at John Lothian and Company. So I was there for about 5.5 years. And since then I moved into the market education element. So teaching people, no matter where they are in their financial journey, how to trade, how to invest, how to manage their money, budgeting, savings, all touch points that you have with money. And that's what we're doing at Britannica Money. We launched that site last September, and we're continuing to add content every day, every week, just helping people with all elements of their financial journey.
And how would you say your background in the derivatives industry, especially since I think you were in it for a good 2 decades, how would you say that came into play with your work at Britannica?
Well, it really helped shape my view in terms of giving me empathy for the end user, the people who used it, because I've been at all those elements. And also it was through that point where I really felt like I had to make that transition from the old world to the new world. And I thought I could really kind of channel all of that, both the quantitative and the qualitative, into these lessons to help the next generation, or anyone who, especially those who are new especially to trading.
Yeah. Well, thank you for that great introduction. Now we're going to pivot our conversation a little bit to more of the options related content, specifically the collar strategy. And one thing I'd like to mention is that I know you actually recently published an article about the collar strategy. So that's something our viewers can go look at online and just get some more information, just because that's exactly what we're going to be talking about today. So my first question is, can you tell me a little bit more about what the collar strategy actually is, and what has been your initial experience with it, and how did you use it in your trading?
Sure. So, well, first of all, when talking about options, it's easy to break things down into why you would be using options in your investments. So, one way is to use it to speculate on direction, buying calls or puts. And then another way is to, instead of speculating on a direction in a capital efficient way, is to use it to enhance or protect a position you may already have. So let's take a stock, for example. Two of the most basic things you can do if you own a stock or any asset is to target income from it, which is via the covered call, which is selling an upside call strike against your stock position. And if the stock rallies up to a certain point, you can use that as kind of an exit strategy, an exit point, or if it doesn't quite get there, then you collect the premium. So it's thought of as an income generation / exit point targeting strategy. Another big basic strategy that you do to, if you have a stock, is the buying a put option, the protection for underneath. So that's buying a put option at a strike below where you're trading, and that way, if the stock were to go into free fall, then you have essentially an exit point there. So now you put those two things together and you have a collar. And the idea of the collar is that you can take the income that you would generate from the premium collected when you sell the call option to offset or at least defray the cost of the put protection. So, but then that, like everything with options, everything has trade-offs. So the trade-off in that is that you are capping your upside potential, meaning if you go all the way, if you go up through the short call strike, of course, then you're done. Basically, your stock will get called away, or else you have to buy it back or whatever. But the point of the collar is to give yourself protection, but not have to pay the premium up front.
Okay, so what was your, I guess, initial experience when you first started using the collar strategy?
Well, as a market maker, I was more the person who was offering bid ask to people who were interested in any number of strategies. So it was really only when I moved to the other side of the table and became an educator that I learned how a retail person would think about employing these strategies. And that's when I was able to start using it from that side of the table. And really, the first lesson that I learned is a reminder in the difference in implied volatility above and below the market. As people who've traded for a while know that the stock market tends to take the stairs up and the elevator down, and thus and the panic tends to be more to the downside. And for that reason, the implied volatility and thus the premium of downside options is generally higher than upside. So when they say you can use the sale of the call option to offset the cost of the put option, it's rarely an equal thing. You're going to, if you say a stock that's trading at $100 a share, and you want to say, okay, well, I'll sell the 105 calls and buy the one at the 95 puts, you're going to get less from the sale of that 105 call than it's going to cost you to buy the 95 put. So then you have that choice to make. You say, okay, well, do I still pay away a little bit of a net premium? Let's say if I were able to sell the call for $1.50, let's say, and you might have to pay $2 for the put, you just say, okay, well, my net cost is 50 cents for the collar. Or you say, instead, I will do something that is buy a put that is 5% out of the money, but sell a call that's only 4% out of the money, because that'll have a little bit higher premium. So then you can say, okay, now I can find a call option that I can get $2 in premium for against that put that I have to pay $2 for. So, but then what that means is your upside potential is capped at a lower rate than what your downside protection is. So that's the trade-off you have to make when you're looking at a collar. It's never going to be fully apples and apples.
Yeah, thank you for that example. It kind of puts things in perspective. My next question kind of relates to it, but what kind of trader adopts a collar? Are they more bullish, or are they more bearish on the market? Can you tell me a little bit about that?
It's generally it is bearish to neutral, and meaning if you're super bullish, you wouldn't want to do anything where you would cap your upside protection, or maybe you would, but it'd be further out. But if you're super bearish, like let's say you think that there's an earnings report coming out or some pending news or something, and you're worried, like this stock maybe has risen a lot, it might be ready for a sharp pullback, but I'm not ready to give up on it long term. You might say, okay, so I'm kind of neutral to the upside, but I'm nervous about that tail risk to the downside. That's when you would want to put on a collar. So if you were just nervous about the downside, but you said, I still think it has a lot of upside potential, you might just say, you know what, it's worth a few bucks for me to just buy the put right now and not sell a call against it. But if you said, the sentiment is a little bit to the bearish side, you might consider the collar.
Okay, so yeah, it's more of a bearish strategy, you would say.
Yeah.
I hope you learned a little bit more about the collar strategy today. I also want to say a special thank you to Doug Ashburn for coming on the show and sharing his knowledge with us. Thanks for watching, and I'll see you all in the next video. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.